Welcome to the Crop Insurance Podcast. I'm Mike Rydell, a third-generation crop insurance agent here to make federal crop insurance less confusing and more useful. Whether you're a seasoned grower or just getting started, we're here to help you stay covered and confident in every season. Today's episode is brought to you by the Crop West Insurance Group, your agent-friendly crop insurance group. If you want more support, smarter marketing, and better tools to help grow your agency, Crop West's expert team has your back. Visit cropwestinsurance.com to level up today. Crop West Insurance is an equal opportunity provider and employer. So welcome to the Crop Insurance Podcast. I'm your host, Mike Rydell, and today I'm joined by a very special guest, Tyson Baker, and we're just going to go a little bit over who Tyson is to talk a little bit about whole farm revenue protection, as he's an expert in that field. So a little bit about Tyson is he grew up in Toppenish, Washington on an apple orchard, and he spent some time in the fitness industry where he grew his own gym for 15 years in Bellevue and Yakima, Washington. He then started in the insurance industry in 2016 with Payne West Insurance, and Payne West was then purchased by Marsh McLennan Agency in 2021. And much to Tyson's surprise, he was the only federal crop insurance agent in the largest insurance agency or the largest insurance company in the country. They've now grown that to a team of 15 people and growing. And Tyson is an integral part of that. And we're so glad to have him on here. And I thought I'd give Tyson a little bit of time here to then explain a little bit more about himself.
Yeah, thanks, Mike. Yeah, again, Tyson Baker with Marsh McLennan Agency. My role with the company is I basically help manage and write most of the federal crop insurance along all the 50 states here that we have. Lots of different stuff. Again, like you noted in that intro, to my surprise, I was the only federal crop insurance agent when we were acquired by Marsh McLennan. A good problem. It's been very exciting times. Lots of great growth and opportunities to work with farmers across the country. I do sit here up in the Pacific Northwest. I'm in Yakima, Washington. Married, have 3 kids, 3 girls. Got my work cut out for me. So definitely my hobby is work and family right now. So yeah, I grew up in Toppenish, Washington. I did come from the fitness industry. Don't judge me on that now, on that right now. I always say I'm just a fat insurance guy, but definitely once upon a time. So yeah, it's good to be here.
Yeah, and there's some funny stories Tyson has from the fitness industry that we'll spare the audience some of those details for maybe another time.
We'll keep it PG today.
Yeah. But so Tyson and I, as I mentioned, we've met kind of off and on over the last couple of years, and we met through the Crop West Insurance Group, and that's kind of an agency cluster that we're a part of, and that, full disclosure, they're the primary sponsor of this podcast. And I'm also a member. Tyson's a member of that as well. And it's just kind of a group to bring like-minded individuals together to help each other learn and grow their business and help the American farmer. I mean, would you say that's a pretty accurate description, or anything you want to add to it?
Absolutely. Shameless plug for Crop West, but they've absolutely changed our business. We do have the opportunity to partner with a gentleman named Gary Heilig Jr., one of my favorite people in the crop insurance industry. I always say, through Crop West in this group, we get to access 6 of the largest AIPs, approved insurance providers, around. But more importantly, we get to work with Gary and Crop West and team as consultants. And it's, that experience is just invaluable. And it just makes our job just that much easier and that much more enjoyable. So.
Yeah, absolutely. It's a tremendous resource. And if you're a crop insurance agent out there, I'd advise you to go to cropwestinsurance.com to check out all their offerings. So that brings us to what we're going to talk about today. Now, I know we've spoken about it before in the past about whole farm revenue protection. I know there's some changes coming, or in theory, some changes coming with the Farm Bill 2.0 or Farm Bill Light or whatever they're calling it. That meeting's coming up here next week where there'll be some changes that may apply for this coming year or the following years. But I thought we'd kind of just talk about what is available. And if you haven't listened to our previous episodes, we have a three-part series. We'll post a link in the YouTube video and in the comments so you can go back and find those. I suggest you go listen to them. They're just kind of a more in-depth look at whole farm revenue protection, more of the nuts and bolts. Whereas we just kind of wanted to do a brief overview. And then by having Tyson on here, I thought we could take advantage of somebody who writes a lot of whole farm revenue protection, deals a lot with it, and kind of get his take on maybe some of the pitfalls, mistakes, things that he can shed some more light on. So, first of all, whole farm revenue protection, just real quickly, kind of the overview of it is that it's a federal crop insurance program, and it's designed to cover your entire operations or your entire entity's revenue. Now, this is all going to be coming from farming income. So whether you have a Schedule F or you can fill out the appropriate paperwork to, I guess, mimic a Schedule F to come up with your average revenue on your operation. You can then insure at a coverage level, and depending on what coverage level you're at, you then have a different subsidy involved. And again, the subsidy is you pay a portion of the premium, the federal government and the taxpayers pay another portion of the premium. So it allows farmers to then access these great programs, ensuring their revenue or their overall revenue at a different coverage level. Now, that sounds very simple. There's a lot of ins and outs and a lot of things that can affect what that revenue is. Now, do you want to explain kind of how we come up with that revenue? That's the top number, and then what it looks like with expected revenue, and then how that coverage level works. Do you want to explain that to people?
Yeah, you bet. You bet. I mean, the elevator pitch, right? The quick understanding that I always explain is that there's basically a few things that we are required to do. One is we try to, we have to put together what your simple average is. And how we do that is we are required to use 5 years worth of tax history. So if you're simply a new LLC and you have no history, well, then you're not going to qualify for it. And we always say it's really actually 6 years, because if I'm looking at the 2026 crop year that I want to start a whole farm revenue policy, well, by the time we write it, we don't have our 25 tax returns. So we actually take 24 and go back. And through that average of 5 years, we're able to create a simple average. Now, let's say for argument, simple math reasons, that it's $1 million average. So we can insure against that. And so currently, as it states, is we can insure 50% up to 85% of that simple average. So at a max in that scenario, it's $850,000 of a guarantee. That's the first thing we're required to do. The second thing that we're actually required to do, and in my opinion is the most important thing, is do a projection into the future, which is what's called a farm operation report. The reason why they require us to do that is they don't want us to basically say, okay, I've got this great insurance product. I've got an $850,000 guarantee. Perfect time for me to rip out half my acres and just let insurance pick up the tab, right? That's not allowed. So then when we put that farm operation report together, that projection could be $1.2 million. Well, if it's at $1.2 million, we get to use the 1 million as our starting point. However, if that farm operation report, that projection is below what our simple average is, that's what our starting point has to be. So it's really important, when working through this, that you go through those different details. And I'm sure in this, as we go through this, there's going to be more that we kind of speak about in detail on pitfalls and, when it does not make sense. So.
Yeah, and that's a key point because there's a very in all insurance, whether it's property and casualty or federal crop insurance, or basically any time you're dealing with contractual verbiage, the verbiage is important. And in whole farm revenue protection, the key word here is lesser of. So you're going to use the lesser of that average. And don't get me wrong, there's ways to do a growth factor and all these things. So you could end up at that 1.2 million if your average is a million. And just hear me that there's some math involved there and certain criteria. You just don't get that. But the lesser of is the big thing. It's what do you have in the field? What are you going to do this year? And like he said, it's a lot of people aren't out there. I would say a majority of the operators out there are not there to scam the system. They just maybe don't have a full understanding of it. So, like Tyson mentioned, they may think they have this great $850,000 revenue guarantee. And I'm like, oh, well, yeah, actually, you know what? I do want to tear that out. So I'm going to tear that out now. And then I have this money coming in from insurance to help convert it to a different crop or whatever they're doing. But yeah, that's not the case.
Yeah.
And so on that farm operation report, that's not a one and done, correct? That's, updated throughout the policy period, correct?
Yeah, that's correct. I mean, there's the initial form that you put out by sales closing date, which typically, if you're a calendar filer, and depending on the county, of course, is March 15th. But then they do have a revised date, which is July 15th. And really what that date is for is to connect with, have you picked up any leases? So have you added any acres to your program for that year? Or have you gotten rid of leases? Did you rip out any acres? Depending on what commodities that you're farming, it's that check-in point. And that check-in point is where it can have an effect and can change coverage. And so people need to understand how those work together.
Yeah, and I think that's key there. And what's kind of interesting, I think, for the listener is you kind of have two worlds here in terms of crop insurance agents. Whereas Tyson's world, that check in is did you pick up any leases? Did you lose any leases? Did you tear anything out? Dealing with the orchards and different crops that he deals with. Whereas in my world, that lease rule still applies, but it's more did you seed the spring crop that you said you were going to seed? Did you
Right.
get the malt barley contract that you thought you were going to get? What's that price at? How many acres have you seeded? What are the conditions in the field? Because a lot can change, as every crop insurance agent and farmer out there knows, from when you meet with your agent at spring sales closing in March to add different crops and varieties and features to your policies to what you actually seed in the spring. And we go over a whole bunch of pitfalls in that in our other episodes when people are seeding stuff they didn't tell their agent they were planning on seeding. So go back and listen to those episodes. But you can see how whole farm revenue is really covering every type of operator. And there's lots of differences between a grain farmer in central Montana and an orchard farmer or a vineyard in Washington or California. But the policy as a whole is designed to protect those individuals. So, I think we've done a pretty good job just doing the brief overview of kind of, how you come up with this guarantee. You're insured at, if you have $1 million operation, you have $1 million in the field. So let's just say it's $1 million is the top number. You're going to multiply that times your coverage level. That's 85% in this example. That's how Tyson's coming up with 850,000. Now you go all the way through harvest. You get everything in. You get discounts at the elevator. You have bruising on some of your fruit, whatever. So freeze damage. You have all these things that occur. So now, what does it look like at the end of the growing season for the farmer in terms of How do they report this math, these numbers? How does the loss work? So can you shed some light on that?
Yeah, absolutely. There's, I think the first key is, there is a little bit of a delay to these policies. And really the requirement is that you have to have filed your taxes for that crop year. So if we're looking at 2025, it's when they file those taxes that really starts the clock to get this done. And so the first thing that we do in my neck of the woods, we insure roughly 85 to 90% of the vertically integrated tree fruit, probably in the Northwest. And so we're dealing with a lot of different, pool closings with fruit, things like that. But most of them, if not all of our clients, we have an underlying MPCI policy. And in order for a whole farm revenue policy to be completed, we have to complete all the multi-peril policies first. And so once those are closed out, then we can venture into that side. And ultimately what they're looking for. So for example, currently we're working through 24 whole farm revenue claims. And so people have closed out their MPCI claims, and now they're getting their tax returns completed, filed, so they could start that process. And then ultimately, what the adjusters are going to look for is they're basically looking for the revenue of all that fruit that was harvested in 24. And so using that example of $1 million average, $850,000 trigger point, if after all that is done, any MPCI policies are processed and all the income from the fruit drops below $850,000, they've essentially triggered a claim. And especially in the tree fruit industry, the one thing I do like about whole farm revenue versus even just a simple APH policy is it's going to cover for adverse weather, but it's also going to cover for market conditions, price decline, right? Price has declined, and that has triggered a very high dollar value amount of whole farm revenue claims in our area.
Absolutely. Yeah. And the key there is if you listen to our previous whole farm episodes is on the MPCI or the federal crop insurance policy, the underlying, whether it be APH or revenue protection or yield protection or all the different products. If you have a loss, that loss income from your federal crop policy counts as income on your whole farm revenue protection policy, which in theory takes away from your potential loss payment from whole farm revenue. Correct?
That is correct. Yep.
Yep. And so why does it do that? Well, the big reason is because by having an underlying federal crop insurance policy on top of your whole farm revenue, you get a substantial premium benefit or a premium reduction in doing so because it does reduce the liability a little bit. Now, there is a way that you can elect to not include that MPCI loss amount in your whole farm revenue protection loss as income. You can elect to exclude it. However, in doing so, dramatically increases your premium, the farmer's premium on whole farm revenue protection. So there's kind of a big balancing act there between those two policies. And so that's why speaking to an agent like Tyson that deals with whole farm revenue protection, or an agent like me that deals with it as well, as how we both deal with federal crop, can help you balance that between, well, from about 85% here and 70% here on the different crops. There's a lot of thinking that's involved in these programs. So I highly recommend speaking with an agent that knows what they're doing, especially when it comes to whole farm revenue protection. It's much more complicated than we're making it sound. So now the real reason we have you on here is because you deal with it, and so much of it, you've been through a lot of claims. And in all types of insurance, kind of like my dad always told me in insurance, is it's never a problem until claim time, right? That's when you find the errors. That's when you find the mistakes. That's when a farmer will come to you and say, I didn't know that. Or even worse, an agent says, I didn't know that. So I thought we'd start with what are the most common mistakes or oversights
Yeah.
that producers make when applying for whole farm revenue protection for the first time?
No, that's a great question. I think the biggest thing that we concern ourselves with is making sure we are heavily underwriting it on the front end versus on the back end, like you said, at claim time. And the biggest key or the biggest thing that we find is that we're now dealing with people's tax returns, and that gets a little bit, it's a little different when you're asking for a farmer's personal information. And the first thing that we look at is typically a Schedule F or a substitute Schedule F. And what we are required to do is confirm that what's on, if you look at a Schedule F, there's line 2 that really should be all of your farming income. Now, not all, accountants, CPAs are created equally, and people do different things. And so we really have to confirm that that revenue is just farming income. It doesn't mean you have a roadside stand and you sold T-shirts and other things like that. And sometimes that pops up. And just to make sure that, again, using that $1 million number as an example, we want to make sure at claim time, if they do an audit of those tax returns, that they don't find a bunch of revenue in there that shouldn't have been there. And therefore it drops down to your simple average of being 800, therefore dropping your coverage level, therefore taking you out of a claim potentially. So we really pride ourselves on making sure that the facts are there so you can make a sound decision. Whether it's good or bad as a business owner, as a farmer, you need to know where you stand. So I would say just on that front end underwriting, looking at taxes, making sure that revenue all makes sense is probably number one, I would say, that we find as a pitfall.
Yeah, that's very insightful. And I think some people overlook that. It's better to get the bad news at the start of the race than when you get to the finish line and that goalpost moves even further or whatever the case may be.
And the one reason too that I would say secondary that we look at is from an entity structure standpoint. We have to make sure that it's not a pass-through account. So we, in our neck of the woods, because there's a 17 million liability limit per entity that you can insure, we've got some vertically integrated tree fruit that's doing well over 100 million. And so they've got multiple entities that are set up for the simple fact that they're trying to put in proper coverage for themselves. Well, we have to make sure that those are separately filed tax returns, that they're not what's called a pass-through, that there's ABC farms, 1, 2, 3 farms, and so on and so forth that all lump to one group. And that oftentimes can become a problem. And that eliminates coverage for people. So
Yeah,
a lot of
absolutely.
front end understanding of the operation and entity is really important.
Yep. Yeah. So again, whole farm revenue is a lot of work. So make sure you're working with someone that knows what they're doing.
Yeah.
What would you say are some of the biggest misconceptions that farmers have about whole farm revenue protection?
Yeah, I think one of the comments that I get a lot from growers when we look at this stuff is, and almost if I could put it in quotes, it's, I'm not farming for crop insurance. And I think there's that misconception of that, oh, I'm trying to play this game. Well, there is no game. You're farming for the best yields that you can possibly put together. And I say, well, here's a highly subsidized program that loss ratios I mean, they're triggering claims. And you can do everything right as a farmer, and you're still dealing with Mother Nature. And I always say Mother Nature, she's undefeated. I mean, she's coming, and it's apparent, and people know that. So no, you're not farming for crop insurance, but it's like looking at someone who's insuring their haystack. You don't hope that it burns up and that you can trigger a claim, but when it does, knock on wood, you're happy that you have it and you have that back end protection. So I would say no, we're certainly not farming for crop insurance. We're just making sure we put the right documentation, right coverage in place that when she comes through and does her thing, which she does, it's there and it works for you.
Yeah, absolutely. Yeah. Every farmer I've had the pleasure of working with would much rather have the grain in the bin than a check from federal crop insurance.
Yeah.
Again, that's why federal crop insurance is an amazing program. It's designed so every $1 you put in is a dollar you take out when you need it. Because not only Mother Nature, you've got the marketplace to contend with. There's so many variables. You're taking every single penny you have, burying it in the ground and praying for rain.
Yeah.
And there's just so much that can happen. And this is a great program, Whole Farm Revenue, all these other ones that are going to keep American family farms in business. Okay. So, how do you help a producer decide whether to keep their FCIC, so their federal crop insurance policies, as primary or elect out of it? Because it's the default to keep it with their whole farm revenue protection.
Yeah, so I mean, I would say almost 100% of the producers that we work with that have whole farm revenue also have a, FCIC program, underlying program. We promote it. I would say I'll use apples for an example, but if you were to purchase a 50% buy up on your multi-peril crop insurance program and a whole farm revenue program that goes over top of that, it's almost the same price as purchasing just a standalone whole farm revenue policy. Because we have that underlying whole farm revenue does get a discount. And the reason why we promote that is there's often years that maybe you don't trigger a full-blown whole farm revenue, but you might have some whole farm revenue claim, but you might have some spot losses. In apples, it's broken out by varieties. Maybe Honeycrisp didn't perform well, or you had a freeze or a excessive heat or whatever it may be. But Galas, Fuji's, Pink Ladies did fine, right? But we're at least covering those Honeycrisp at that 50% level.
Yeah, that makes a lot of sense, and some good insight there. Is there's every operation is going to be different and have different exposures. They may want to cover some shallow losses with that federal crop and pick up that additional premium subsidy on their whole farm revenue protection. It's just a way to get a more or a deeper level of coverage. And anytime you can shrink coverage to a specific area or a variety or some small part of your farm to protect yourself from a loss there, the better the program works, in my opinion.
Yeah.
So when you walk through a new producer or a new grower, and what parts of whole farm revenue protection tend to require the most explanation or require you to do the most to, ease up some confusion on the policy?
Yeah, I think it's how we come to those numbers that we talked about earlier. I mean, the tax returns are the tax returns. Obviously, I think in previous podcasts that you've put together around whole farm revenue, you've explained about, we have a revenue exclusion, we have indexing, we have different ways that we're ultimately just trying to get the liability as high as possible. But then again, that projection, that farm operation report is probably, in my opinion, the most important form that we put together to make sure the policies in place, as we, are at the highest level that we talked about. And really it boils down to how do we come to those numbers? And every commodity is a little different. If you have a contract, then we are required to use contract pricing. If you have an NPCI policy, we can use your yields from that to basically come to the number for whether it's wheat, apples, corn, you name it. But it's really trying to get that farm operation report as high as possible. The other big part is really the strategy that it comes down to, and this is where sometimes it makes sense that you don't purchase it. So I'll use the example of saying, okay, let's say we have $1 million average, and currently the most we can insure up to is 85%, so an $850,000 trigger. But let's say, for example, my farm operation report, because we're growing, or maybe we've picked up another lease or whatever it may be, my projection's at 3 million. Well, I've got an $850,000 trigger, but a 3 million projected price. Doesn't really make sense because we're growing and maybe we've used every endorsement that we can, and a million's the highest that we can get. That's where we do see a lot of people that say, okay, well, maybe I want to create another LLC and start to break this out. And there's a lot of different strategies that people are using to be able to set, their program in place.
Gotcha.
Or
Yeah.
you might make the decision to say, we're just way off basis. This is not the time to purchase this. Maybe we want to kind of beef up or increase our coverage levels on the other programs, add an SCO, an ECO, whatever it may be, to make sure we have good protection.
Yeah, absolutely. There's many products, not just whole farm revenue protection that you can utilize. But again, speaking with an agent that deals with it and is in that world is pretty crucial to help explain those potential pitfalls or potential strategies if you have the positive aspect of your growing. Some farms are getting bigger. And so this is a problem they have to deal with in order to adequately insure their operations for sure. Now, we've talked a lot about kind of these bigger operations, people getting huge, that have been around for a long period of time. They have 6 years of history, 5 years of history. What about these smaller direct market farms that are, might be new producers and new farmers, or they have the beginning farmer ranch program, the veteran, the VFR, BFR? Where do they fit into this program? Is this just for a $17 million operation, or is there room for the little
No,
guy or gal?
no. I mean, the beauty is that you're protecting revenue, right? Revenue is, it's all relative. It all matters. And so there is a micro farm product if you produce $350,000 or less that you can fall into. And the nice thing is you're not required 5 years worth of history. You're required of 3 years. It's a little bit easier on the actual farm operation report, that projection, things like that. It's something that's definitely taking flight. That product is increasing across the country. Typically, we see, if you have like a roadside stand or you're kind of direct to market grower, you've got a lot of commodities, and not all of these commodities have an underlying multi-peril policy available to you. That is where a whole farm revenue or micro farm actually does come in, because there's protection for you. And I'm of the belief that if I can protect my revenue over just production, I'm going to take the revenue every time.
Yeah, absolutely. Great point. The whole farm revenue protection and crop insurance in general are for farmers of every size. There's not necessarily a minimum it requires. I mean, you can look to livestock risk protection where the minimum is one cow. So these don't have to be these huge operations. They just work for people in agriculture, and working with a professional licensed crop insurance agent is going to be your ticket to being educated on these programs and leveraging them to protect your farm. So I guess we're kind of towards the end here. So first of all, I can't thank you enough for being on here. This is our very first video interview. So thank you for being brave. And,
Yeah, yeah.
I just can't thank you enough for our relationship as colleagues and friends, and you being on here. I very much appreciate it. Is there anything you would like to add, or any other thoughts you want to throw out there for our listeners?
Yeah, I mean, I would look at it this way around the whole farm revenue product. Just this morning, I looked up, I study loss ratios, and loss ratios meaning, every dollar that the farmer put in, what's the amount that came back. In the last 5 years, the loss ratios for whole farm revenue, and I don't know if this is a good thing or not, but the whole farm revenue loss ratio has been between 200% up to 662%. So every dollar that's put in, and I'll use 2023 for an example, $6.62 has come back to the grower. That's the farmer paid loss ratio. So these programs are here for a reason. They do work if you know what you're doing. They're vital. They're important to keep these growers growing. So don't shy away from it. Make sure you at least consider it and do your due diligence because it really does matter.
Awesome. Very well said. Well, Tyson, thank you so much. I very much appreciate you being on here.
Yeah, thank you. Appreciate it, Mike.
From my family to yours, thank you for tuning in. If you found this helpful, please subscribe and share with a neighbor. Visit www.cropinsurancepodcast.com for more episodes, articles, and tools. For full policy details, always check the crop insurance provisions or speak with your local crop insurance agent. This institution is an equal opportunity provider and employer.